This line represents a high-precision trade. The downward limit, the stop loss, is microscopic. But because that risk is so small, even a moderate vertical spike results in a 1 to 10 payout. The goal is to reach a point where one win pays for 10 consecutive losses. The micro-wap tracks price as it falls, bar by bar, cornering it into an entry. But this only works under one condition. Attempt this in the middle of nowhere, and the market stops you out. The technique must be anchored to a macro-level support zone. Microscopic risk management is useless noise without that high-probability context. You are using the macro structure to protect your micro entry. On the micro level, we watch for a pullback to form. As these 3 red candles descend, we place a horizontal pending buy order exactly on the high of the current candle. If the next candle closes lower, the pending order shifts down to the new high. We repeat this for every bar. The trade triggers the moment the price reverses and pierces the high of the current tracking candle. We place our stop loss strictly beneath the bottom wick of that specific trigger candle. We add a tiny buffer to account for the broker spread, ensuring the trade is enclosed by minor price flickering. Stalking the price bar by bar minimizes your exposure. By the time you enter, the price has already begun the reversal you were waiting for. Real-world markets often pause rather than falling in a perfect straight line. This is an inside bar. The second candle's range is completely trapped within the one before it. When we see this, we tighten the entry, lowering our pending order to the inside bar's high, rather than waiting for the larger candle to be breached. Structurally, this inside bar represents a microscopic compression of momentum. It allows for an even tighter entry without requiring a new lower low in the sequence. Microscopic stops are fragile. Because the entry is so tight, the first attempt is often wiped out by a single erratic tick. Here, price triggers the entry, but immediately crashes through the stop, resulting in a 1-unit loss. If the macro support holds, the trader restarts the trailing process on the next candle. This second attempt catches the true structural reversal, shooting the trade into deep profit. Each failed microstop filters out a false start. By the second or third attempt, the downward momentum is often exhausted against the macro support, which is why these later entries have a statistically higher success rate than the first. This strategy treats every entry as a low-cost option, allowing you to reload until the true structural reversal finally ignites. The challenge here is psychological. You must have the mental stamina to execute the third attempt with the same discipline as the first. Look at the account balance logic. 3 micro losses create a tiny drawdown, but the vertical spike from a single winner eclipses all previous highs instantly. Let's test your recall. On this messy downtrend ending in an inside bar, pinpoint where the entry and stop loss should go. Pause the video now and decide. The entry line sits on the inside bar's high. The stop loss sits right below its low. Here's the micromap checklist. Anchor your context first, trail the candle highs, set a microstop with a spread buffer, and always reload for subsequent attempts. Mastering this strategy changes your relationship to losing. Small stops aren't failures. They're the low-cost intelligence you need to find the real move.